In traditional blind funds, there's no transparency on what true investments are happening. There's no transparency on how much money the management team is making. There's no transparency on fund expenses. It's very, very difficult to get data out of a blind fund. And you're basically going in blind, trusting that the operator is legit, doing the right things and trusting them without really having the data, which is part of the reason where we see our business taking off, because investor sentiment has changed and investors want transparency. They want visibility. They want to know what's happening.
Greetings. My name is Akash Jain. I'm your host for today, and I'm super excited to welcome my dear friend Sanjay Vora, who is the CEO of Avestor. Sanjay, welcome to the show.
Hey, thanks, Akash. How are you today?
Very well, thank you. Sanjay, I'm super excited because you are one of those people that I know who knows a lot about investing and a lot about not only investing in multifamily and real estate, but also in various different asset classes. And you
Yeah.
run the fund management group, which has a lot of these various different asset classes at fund managers. So I'm super excited to have you on the show today.
Thanks, Akash. Happy to be here.
So, Sanjay, to start us off, can you talk to us a little bit about your background and how you got into this whole fund management space, if you may?
Yeah, it's not your typical, out of college path for me. It was quite different. So I've actually been in the tech world for over 2 decades. Was at Intel, kind of worked my way up in Intel over 20 plus, 23 years, and spent most of my time in the corporate world. But back in around early, 2012, 2013, right when crowdfunding was coming out and starting to get popular, I started thinking about, hey, I want to invest beyond the stock market. And so I started, really digging into crowdfunding, looking at, hey, what's out there, all the different platforms that were out there. And I've basically, I go back to some of the early ones like Realty Mogul, Realty Shares, quite a few of them out there. So I ended up starting to like say, hey, I want to, really spread my wings, pulled a bunch of money out of the stock market and started investing into various platforms. So I started there. I did some equity and syndication deals. Then I did some debt deals, and then I, did direct syndications and just kind of spread everywhere. Tried a lot of different things over about 4 or 5 years, and really got my feet wet as a passive investor and learning the space and making money, but losing money too. And it was really when I was losing money that I started getting smarter. And so as kind of the years went on, I started realizing, hey, this isn't as simple as it should be, and it's quite complicated. And so that was kind of what led me in 2018 to start my own company, Avestor, really to go focus in this space. But kind of started out as as an investor, a passive investor. Then started Avestor and became a private fund manager because I'm like, hey, there's an opportunity to help others. So we started our own private fund. That was sort of the kickoff in 28. And then as we were doing that, running our private fund, we started building our own software platform. And then about 2021, we're like, hey, we've got something here that we can offer others. And so then we took it out and started started offering private funds to others as well. So that was sort of the journey is how we got here.
Great story, Sanjay. Hey, from being an LP to then becoming a GP and then to start your own fund platform company. Let's do a plug in here for Avestor. Let's talk a little bit about hey, what does Avestor do and how do you support? I believe it supports mostly the GPs. How do you support the GPs and the fund managers? And is there a
Yeah.
play in there for LPs as well?
Yeah. So one of the things we realized was as we were new to the fund management space, I realized that, my God, this is so hard and it's so painful and it's so complicated. And this is why, normal, you got to have before you used to have so much money and attorneys and all kinds of people on your side to go start your own large private fund. And we're like, hey, there's an opportunity here to raise capital simpler and easier and make it easier for everybody. And so, we started out kind of as a tech platform, but, given that we were also fund managers and seeing the pain points, we knew it was much more beyond a tech platform because people needed help with the legal documents. People needed help with strategy. People needed help with marketing, accounting, bookkeeping, fund administration. So what we ended up doing was saying, hey, let's offer a broader set of services. Let's sort of be an end-to-end solutions provider that includes a leading edge tech platform, but also helps managers and anybody that actually wants to raise capital, with kind of an overall end-to-end solution. So kind of being more of a business partner than just purely a tech platform, and providing the business guidance and advice when you need it. We try not to intrude in others' businesses or try to intrude in their funds, but we want to be there as their support system, that when they need the help, they can come to us and they're not like wondering, we become kind of their first resource is really what we're trying to do.
Got it, got it. Now, I know on Avestor there's a lot of different kind of asset classes that you support.
Yeah.
Talk to again my fund, multi-asset generational, which also is, by the way, hosted on Avestor. It is our claim to fame, or our USP is that hey, we are agnostic of the asset classes. We dive
Exactly.
into different asset classes. Talk to our investors here a little bit about different asset classes that Avesta supports. But not only that, what have you personally dived into? What different asset classes? What is your favorite and why?
Yeah, so I would say a lot of my money went to real estate personally, right? So, a lot of the traditional typical asset classes is where I started out: single family, multifamily. I did some office deals. I did a couple hotel deals, medical parks, and really spread my money, right? So I didn't put a lot of money in any one deal, maybe 25 to 50,000. Really tried to build a diversified portfolio, kind of the way I do it in the stocks. And so, even on the debt side, I always put in, did a lot of small debt notes along the way. And I would do like say 5 to 10,000 on each debt note, fractionalized. And so it allowed me to really have a portfolio of 50, 60, 70 different investments at any given time, and really build it out similar to exactly the way I did in the stock market. And so I would say most of it was in real estate. I did a little bit of outside of real estate on the personal side, but probably not as much. I've done a little bit of crypto, obviously. Everybody's done crypto at this point. But beyond that, I haven't done too many different alternative asset classes outside. But in real estate, I've done quite a few different ones personally. Now, Avestor, we've started going broader. Again, we started Avestor also on the real estate side. Started primarily in the multifamily space. So a lot of our initial customers were multifamily. But what we found was that we started getting a lot of interest outside of multifamily very quickly into RV parks, into RV campgrounds, into offices, into medical offices, into hotels, commercial retail. So we very quickly found the breadth of us hitting pretty much ADUs. There's just so many different asset classes and so many different luxury campgrounds is the newest ones we're seeing. So we did there. But then what was interesting is as we started doing that, we started getting interest from people even that we weren't reaching out to. So we've got a Forex fund on our platform. We've got a couple crypto funds on our platform now. We've got a couple oil and gas funds on our platform. We've got a lot of interest from like startups, where a couple fund managers have basically wanted to build out a franchise. And so what they've done is they've used our platform to raise capital for each location that they want to, buy the franchise in. And so they've kind of used that as a way to scale their own scale up into the franchise side. We've got a couple PE firms that are, basically buying startups. So it's expanded. I would say we hadn't originally thought it was going to go that broad, but it's gotten pretty broad in terms of the different types of classes that we have on the platform now.
Very cool. And I believe, hey, having seen you in the masterminds for Avestor, you are the resident expert and advising a lot of these funds on how to run their funds. One thing that sticks out is Sanjay, I've seen there's a lot of debt funds lately on the
Yeah.
Avestor platform. Talk to us a little bit about how a debt fund works and what is your take on it. I don't have a very positive take on debt funds, but maybe I'm wrong. Talk to us a little bit about debt funds.
Yeah, so I think when we started, I started from an investor standpoint, right? And so from an investor standpoint, I always think about diversification. And for me, diversification is a combination of income and growth. And so when I think about debt, I always put it into the bracket of ongoing income. And when I put it into when I think about equity, I always put it into the long-term growth option, right? And I like to kind of, as an investor, be in both spaces. One of the things we've seen is a pretty significant transition happen over the last 12 to 18 months, where investors, partly because of what happened with the interest rates rising, with those interest rates rising, cash flow started getting tighter on a lot of deals in the syndication space and the equity space. So what we started seeing was that sponsors were starting to fall behind on payments to investors. So investors went into equity deals thinking they were going to get 7-8% prefs, cash flow very systematically. But as sponsors started seeing interest rates rise, the money was started going to the banks to pay the higher interest rates. Cash flow started drying up, and so investors all of a sudden started going negative. And so we saw a sentiment change across our platform where a lot of direct investors started switching in that they didn't believe in long-term equity anymore, or they had too much tied up in long-term equity that they were like, hey, we don't want to be in more 4 or 5 year deals because the deals we got into 4 or 5 years ago that were supposed to exit haven't exited. So now they're sitting on a bunch of long-term equity that isn't exiting. And now they're going, well, okay, I'm going to just shore up my debt side, right? Because I want regular income. And those are usually shorter deals. And so we saw this transition happening where a lot of investor interest shifted from being high IRR targeted equity deals to being just more conservative. Hey, I want 8%, I want 9%, 10% month on month, but I want my monthly income. And so that's why we saw this huge shift happening where a lot more interest went into debt funds and debt offerings just because the investor sentiment changed over the last 18 months. And people are just a little bit more, resistant to these long-term deals because they just feel like they're stuck in them forever and they're not getting their money out. And so that's kind of the rationale behind why we're seeing it.
Great. Now, this is getting interesting, Sanjay. But before we get more into it, I wanted to ask you a personal question, right? Hey, if you go to a karaoke bar, whether Bollywood or Hollywood, what is your favorite song to sing?
I don't sing karaoke. I don't think I've ever done karaoke. I would love to do it one day, maybe when I have a few drinks. But I don't think I have a favorite song because I haven't actually ever done karaoke. Isn't that
So why
sad?
don't we put it on the cards for the new Avestor retreat we're going to have in October then?
That could be something we would definitely do. I want to, when we have our retreat in October, I definitely want to put in some more fun things that we will go do. So yeah, we could definitely add that one to the list.
Great. Sanjay, hey, it's continuing a conversation on the debt funds, right? What I have also seen is a lot of the deals which were done in real estate because of the interest rates and because of the bridge debts and so on and so forth were started going south, or people were
Yeah,
not able to pay their loans. And what I also saw was some of the same operators coming up with debt fund deals, trying to
yeah,
save their real estate investments. So
yeah.
that is where I got jaded by the fact that hey, nah, they are taking the money, additional money from the investors now in the form of debt funds and trying to save their real estate deals. And not only that, a lot of the time the debt fund says mostly, hey, let me get more new money in to pay the interest for the old money, and which kind of smells so like a Ponzi scheme, if you will.
That sounds like more of a Ponzi scheme.
Yes.
I would say that's not what we're seeing on our platform. If an operator is doing that, that would definitely be huge red flags for me. I do see operators that offer debt and equity at the same time, which I don't think is a bad deal. If you have a new deal and you want to, put a debt offering in for investors that want to be in on the debt part of it, and some that want to be on the equity part of it, where the equity they get the long term gains, they don't get the short term cash flow, and the debt guys get the that I think is okay. But I mean, I agree with you. If you've got an operator that is basically doing a debt offering to save an equity. It can be done. I'm not saying it can't be done, but there has to be very, very clear disclosures from a legal standpoint on what level. Obviously, they're doing it because the property's distressed. And if they're saying, hey, this property's distressed, I'm going to lose it to the bank, everybody's going to lose. I want to put an offering out there. And the people coming in know that it's a distressed property. They know that what they're getting into. And the existing equity investors know that, hey, this is happening and it's not being done behind the scenes invisibly. As long as everybody is disclosed and everybody's in the same on the same page on what's being done, why it's being done, and that it's being done in behalf to ensure that the deals doesn't completely fall apart and the investors don't lose all their money, then I think it's, but I don't know if operators are actually doing it that way. My guess is there's a lot of shady operators out there. Um, and that's again why I always tell people, be careful and not to overinvest. Just like you have diversification on asset classes, you have diversification on deals, you want to have diversification on markets, you want to have diversification on time, you want to have diversification on equity versus debt. You want to build a diversified portfolio, period, full stop, because that limits your risk, just like you would do like in any other business, right? You want to manage risk. And so I would say if these operators are not doing their full disclosures, then I agree, it does smell like a Ponzi scheme to me at that point.
So for our investors, then, Sanjay, how should someone go about, if you're an LP, how should you go about doing your due diligence on a debt fund? What questions to
Well,
ask? How do you go lift up the curtain and see what are these people investing in? Is it, what are the assets behind, and do they have first lien position, second lien position? How do they go find out about it? Because a lot of this is not public knowledge.
yeah, this is the problem with blind funds, which is why we kind of created the whole customizable fund. Because in traditional blind funds, there's no transparency for the investor. There's no transparency on what true investments are happening. There's no transparency on how much money the management team is making. There's no transparency on fund expenses. It's very, very difficult to get data out of a blind fund, and you're basically going in blind, trusting that the operator is legit, doing the right things, and trusting them without really having the data, which is part of the reason where we see our business taking off, because investor sentiment has changed, and investors want transparency, they want visibility, they want to know what's happening, and they're okay with losing money on a deal here and there. It's no different than losing money on the stocks. You're making bets, but you want the transparency to know what bets you're making. So if you're an investor and you're going into a blind fund where you don't know exactly what's happening, then I think it's up to you to spend a lot of time doing the research, and don't just assume because somebody tells you they've got a $500 million debt fund or $500 million under assets. That doesn't mean they're doing something good. That just means they're damn good at capital raising. So that doesn't mean they're a good operator, right? And so it's really important from an investor standpoint to not get caught up on the numbers, because the numbers can get overinflated everywhere. We see it all the time with in multifamily, where people will say, oh, I've got 2,000 doors under management. You peel the onion and you realize they've got 3% stake in a 300 unit apartment where they're doing nothing other than calling themselves a co-GP so they can raise capital, which by the way is completely illegal. But they do it anyways, and then they make their numbers look really big so that they can go make it easier to raise capital. So as an investor, I think it's super important, if you're looking at a debt fund, to peel the onion and say, okay, really, what is the operator investing in? What kind of deals are they planning to invest in? What is the business criteria of that debt fund? Because if it's a blind fund, they have to specify exactly the deals, where they're going, what they're trying to do. And then I would actually go the other way, and I would look at their historical track record on communication, because the big thing that you can tell by good operators is they communicate. And when things go bad, they communicate. When things go sideways, they're honest about it, that the deal is going sideways. It's the operators that I see out there right now that I know their deals, because I'm in some of those deals, that are the deals are in total shit, yet they spin it like, oh, everything's good, everything's lovely, yeah, we've got this, and they spin this marketing thing with big smiles, and it's like complete BS in my mind, right? It is. These are the guys that, I won't name names, but there's some big players out there that behave this way, and you should be super careful. If you're an LP, about investing with these guys, because they got big smiles and they're not being honest. So as an LP, I think it's really important to do your research, understand, the deals, the fund, the business, and really make sure you've done due diligence on the operator. Talk to some people, do your own research, and see if there's any lawsuits against them. Some of these operators do have lawsuits against them as well. And really, before you start putting money in. That's the best I can say, right? I mean, due
Those
diligence
are
is
some
key in this
amazing
business.
nuggets, Sanjay. But also help me also understand: are there any tools available where somebody can find out, hey, who is on first lien position, who is on second lien position? Does Avestor have some tools for LPs to? I know you guys do some background checks and so on and so forth for GPs, but
Yeah, we
what
do it.
is
There isn't that much, which is why it's tough, right? There isn't a lot of in private offerings. There isn't a lot of players out there that have data sets that are tracking, failure rates of sponsors and operators, and good operators from bad operators. Yeah, there's a few companies out there that put like stars, like quote, we certify the operator. That he only goes so far as well, because their business model is they're getting paid by the operator. So can you trust somebody who's getting paid by the operator about the data they're giving you about the operator? There's a little bit of conflict of interest there. So I would say that is where it's a little bit more, in the private space, you have to be a little bit more, you have to take the time to make sure you really do your due diligence. I don't think for us, we do deep background checks, we do criminal checks, records, history before we let any fund manager on our platform. So we do those checks. We don't do it for direct investors, because it is very sensitive data, but we're doing it because we're trying to follow regulations. Ensuring we have good operators that are coming on our platform, and we don't have folks that are bad actors. But it is tougher for investors, I'd say. I would say the best you can do is get out there and do a lot of Google searching, do a lot of records, see where they're at. Maybe you could even run your own background checks on them, especially if it's a large amount of money. You definitely want to do it.
very cool, very cool. And Sanjay, hey, again, we'll dive into one personal question here. Hey, what is a comfort food that you generally gravitate towards? Either go up, get up in the middle of the night, go to the fridge, and get that out. Give us an example there.
I'm a cereal guy. So I've got big bins of cereal, and when I get hungry, I just look at my 3 or 4 bins, and my wife really hates it, but I'll just go in and I'll grab some cereal in my hand and eat it. So I've always been a cereal guy. I just
That's
love
healthy
it.
too, man. That's also healthy.
Some of them are healthy, some are got a lot of sugar in them. They're not always healthy. So
Great, Sanjay. What I'm going to do is give you the hand you the crystal ball now, and help our investors figure out what should they be looking at in the remainder of 2025. We have about 6 7 months remaining, 6 months remaining, really 6.5 in the year. What is it that they should be looking for in 2025 as well as in 2026? Anything that should be they should be wary of? And I know there's a lot of money sitting on the sidelines, but
there is a lot of
with your
money.
crystal ball, what would you say?
I would say there's a lot of newer asset classes that are coming up in real estate, a lot of new innovations. I would say look for, don't go after traditional deals. Look for where there's new innovations happening and new change happening, and really ask the operator of any deal you're going to invest in on why they're different than typical deals, right? Because there's a lot of normal deals out there, right? Whether it's multifamily, whether it's office or it's retail. But I would say go look for the unique opportunities, and go look for things that make the deal different, and what is the operator doing that's different than the traditional model. And some people say go the other way, and just go with the proven stamp. But I think we're in turbulent times right now, and and there's no saying which way people can predict if interest rates are going to go up or down. Everybody's going to have their own predictions. People are going to say, some people are saying we're going to be in a recession by by end of this year. Others are saying no, everything's fine. So I don't think nobody has the crystal ball. So from an investment standpoint, as an investor, number one, my rule of thumb always is diversification. If you've invested in the Northeast, go invest in the Southeast. If you've invested in the East, go invest in the West. If you've been in multifamily, go try your space in another asset class and learn that asset class. If you're mostly an equity player, go try debt. If you're mostly a debt player, go put up some money in equity. So really, the smarter you get, the more you diversify, the more you learn, the more you talk to different players. As an investor, you start picking up a lot of nuggets. And that's really what I've done over the years, right? Is the diversification across all these different things is what's made me a smarter investor.
Some amazing nuggets there in our conversation today, Sanjay. I thank you so much for being a
No problem.
guest on our show. It has been a pleasure. It was really wonderful to talk to you today. Thank you. Thanks a lot.
Hey, thank you. Great seeing you, man.
Bye. Thanks.